Do you want your kids to start their careers with huge student debt? When you add all the university expenses including tuition, books and living cost, an average 4-year university program can cost up to $100,000. So how are your kids going to afford university without depending on a student loan? As a parent, you can help out your kids by opening a registered education savings plan. In this video, I'm going to explain what RESP is and strategies to grow RESP to more than $100,000. So without wasting time, let's get into the video. If you're not taking advantage of RESP account, you are leaving free money on the table. Only 40% of Canadian parents utilize RESP. From the name, it might sound like a savings account, but this account can be used as investing account as well. Many Canadians are scared to utilize this account as an investing account because they are scared to invest and they don't want to bet on their kids' future. Even if you use this account as a savings account, you can still make a return of 20% from the government grant alone. We can get to that later. RESP is a tax-sheltered account, meaning any money made in this account will not be taxed on its growth. So if you make dividends, capital gains or interest, it won't be taxed as income. The maximum lifetime amount you can contribute to an RESP is $50,000. There is no annual contribution limit to an RESP, but the government CESG program will only match the first $2,500 annually. So if you can contribute $2,500 a year, the government will match 20%, which is $500. If you contribute $3,000, the government still will only be able to provide $500. You can claim up to $7,200 per child using this grant. To maximize this $7,200, you can contribute $2,500 for 14 years, and for the 15th year, you can contribute $1,000. In the 15th year, you will have a total of $36,000 in contribution, plus you will also have $7,200 in grant money. In total, the account will have a balance of $43,200 when the child is 16 years older. Here you're able to make $7,200 from a $36,000 investment. That alone will be a 20% return. Plus, if you're able to get an average return of 6%, this account can do its compounding magic. But we can discuss some maximizing strategies later in this video. Remember, your maximum RESP contribution is $50,000. So at this point, you can still have your remaining contributions of $14,000. You can still make contributions, but this contribution will not be matched by the government grants. If you still want to make contributions and if you have room in your TFSA, it's better to use TFSA because it's easy to make withdrawals from your TFSA. You can hold stocks, bonds, REITs, ETFs, mutual funds, GIC, and cash in your RESP. Most parents look for a safer investment vehicles as they prefer not to lose their kids' college fund. Like RESP, we won't be able to use this contribution for a tax deduction. Plus, some portion of this fund will be taxed upon withdrawal. But we can get to that later in this video. Now let's talk about RESP rules to remember. RESP account can be opened by parents, guardians, grandparents, relatives, and or even by friends. But it should be opened on behalf of the child, and the child must have a social insurance number. In RESP, you have a contribution room of $50,000. But the government grant and the investment growth is not included in this $50,000. Like other tax-sheltered accounts, you will have to pay 1% tax on our contribution. There is no yearly contribution limit on RESP. So if you want to contribute the entire $50,000 in the first year, you can do that, but you will only get the government grant of $500 in the first year, and you won't get the grants for the remaining year because you already met the contribution limit in the first year, and government will only match 20% of the first $2,500. So if you want to utilize the government grant, you need to contribute $2,500 for 14 years and $1,000 in the last year in order to get the maximum $7,200 in grants. If you're enjoying this content, hit that like button. Our contribution tax is only calculated on the excess amount. If you contributed $51,000 in the first year, then our contribution tax will be only applied on the excess $1,000. If you can withdraw it after 2 months, the tax will be only calculated for 2 months. The government will stop contributing the grants when the child turns 18 years old. So try to get the entire $7,200 in grant money before the child's 18th birthday. Even though the government grant money will end, you can still contribute for 31 years since the account is opened. And we are allowed to keep a RESP account open for 36 years so that the beneficiary can still attend school in his 30s. Now let's talk about the CESG government grant money. If you have not utilized the entire CESG grant money in 1 year, CRA will allow you to catch up the next year. But CRA won't carry forward the unused contribution room for many years like TFSA or RRSP. Let's look at an example here. If you contribute $1,000 in the first year, you will receive $200 in grant money. Here you have unused grant room of $300 because the maximum grant you could have received is $500. CRA will allow you to carry forward this 300 grand room for the next year. So if you can contribute 4,000 next year, you can get grant money of $800. CRA won't allow you to carry forward more than 1 year. The CESG grants are available to everyone regardless of your income. If the family income is between $50,000 and $197 and $100,000 and $392, they are eligible to receive additional $50 to their CESG grant, which makes their total grant to $550. And if the family income is less than $50,000 and $197, they are eligible to receive additional $100 a year, which makes their CESG grant a total of $600. Even though the CESG provides additional amount based on the family income, the total grant receivable is still $7,200. The families that receive additional amounts will be able to max out the $7,200 faster. If your family falls under any of the following income criteria, you will be able to receive $2,000 to your RESP from the Canada Learning Bond. The first $500 will be paid in the first year of eligibility and the $100 will be paid each year until the child is 15 years old. If you're interested in applying for provincial and federal grants, I highly recommend you to make an application to Student Aid in your province. When you make an application, they will also assess your eligibility for grants that is available to you. If you found the content valuable, consider liking the video. With your likes, this video can reach new audience. Now let's talk about investing strategy. Here I will show you 4 scenarios on how to maximize your RESP. Let's look at the first scenario described at the beginning of the video. Here we are contributing $2,500 per year to get $500 from the government grant every year. If we can contribute $2,500 for 14 years and $1,000 for the 15th year, we will have a total contribution of $36,000 plus we will also have the $7,200 in grant money. In total, our RESP account will have a balance of $43,200 when the child is 16 years old. Now let's look at the second scenario. Here we are projecting the future RESP value based on the investment return for 18 years. Here we are contributing $2,500 per year and we will get $500 from the government grant every year. Here we are maximizing our $50,000 contribution room. In the previous example, we stopped our contribution at $36,000 because we were able to get the maximum CESG grant with our $36,000 contribution. If we can max our $50,000 contribution room, we can get $7,200 from the government grant when the kid turns 19. At a 5% annual rate, this investment can bring us $43,654 and our total RESP will have a balance of $100,854. Now let's look at the third scenario. Here we are contributing the entire $50,000 when the kid is born. Since we are not contributing any other years, we will only get the government grant from the year 1. At 5% annual return, this investment can bring us $83,492 and our total RESP will have a balance of $133,992. Even though we only got $500 from the government grants, our investment returns provide us with more returns as compared to the second scenario. And it's because we contributed a huge lump sum in the first year. Now let's look at the fourth scenario. Here we are contributing $16,500 in the first year and we are getting $500 from the government grant every year. If we can max our $50,000 contribution room, we can get $7,200 from the government grants when the kid turns 19. At a 5% annual return, this investment can bring us $62,386 and our total RESP will have a balance of $121,486. If you can afford to invest a lump sum to your RESP, go for the third or the fourth scenario. And if you don't want to contribute a lump sum, go for the first or the second scenario. If you're enjoying this content, hit that like button. If you're planning to invest in your RESP, I highly recommend you to hold bonds and ETFs in the account as they are considered safer investments. If you sell stocks at a loss in a RESP account, you will lose contribution room. In a RESP account, you will be charged 15% withholding tax. If you're planning to hold high dividend paying foreign stocks, RRSP will be a good option as RRSP does not have withholding tax. If you're interested in opening a RESP account, I would recommend using National Bank Direct Brokerage or Wealthsimple. If you're planning to hold US investments, go for National Bank. And if you're just planning to hold Canadian investments, go for Wealthsimple. I will add the links for both brokerage in the description. If you use my Wealthsimple link, you can get up to $3,000. Now let's talk about RESP withdrawals. The RESP account consists of 3 pools of money: the contributions we made, the grant money we received from the government, and the investment income we received from our investing. Each pool has its own withdrawal rules. Let's talk about contributions first. Contribution can be withdrawn tax-free. The contribution can be withdrawn by the child or the subscriber. Any contributions that have originated from the government such as CESG grant, Canada Learning Bond, and the provincial incentives can be only withdrawn if the beneficiary is enrolled in a qualified full-time or part-time program, and the beneficiary must be 16 years old. The withdrawal of contribution will be taxed under the student. Since student can receive various tax credit, there won't be much tax consequences. The income portion of RESP is also subject to income tax. The income portion of RESP can be withdrawn by the student, and the unused portion can be withdrawn by the beneficiary as well. The student also has to provide proof of enrollment to withdraw from this pool. Now we can discuss the common withdrawal rules of grants and income portion. To withdraw grants and income portion, the student should provide a proof of enrollment with the details of the institution, including postal code, length of the program in weeks, the number of weeks of study per year, the current year of study, and the course start date. It's always advisable to use grants and incentive portion first before you touch the contribution. This is because contribution can be withdrawn anytime. If government incentives and income portion remain in RESP after the beneficiary has completed school, there may be negative consequences. The unused government incentives may have to be returned to the government, and the unused income may be taxed heavily. If the child is attending full-time training, the child is allowed to withdraw $5,000 in the first 13 weeks from the grants and income portion. And if the child is attending part-time, then the withdrawal limit is $2,500. If the child needs more than the withdrawal limit, they have three options. They can wait for the 14th week, or they can withdraw from the contribution portion, or they have to request to CRA to increase the rate. This is granted case by case. After the first 13 weeks of school, the withdrawal limit is removed. If the student who is attending the program is considered as a non-resident of Canada, and if they would like to withdraw from income portion, withdrawal can be subject to 25% withholding tax. You can use your RESP to cover tuition, books, transportation, housing, food, and all other education-related expenses. Your financial institution won't ask for receipt as long as the request is within the annual limit. The 2022 EAP limit is $25,268. If you need to withdraw more than your limit, you can withdraw it from your contribution portion. And if you don't have any contribution left, you could make a request to the Minister of Employment and Social Development Canada. You should avoid riskier investments in your RESP. If you lose money in RESP investments, losses will be applied against the amount of investment income available, then against the principal contributed. If both the sources are exhausted, the remaining losses may be applied against the government incentives. Now let's discuss what happens if the child decides not to attend school. The first thing you can do is to wait for the child to change their mind. An RESP can stay open until the child turns 35 years old. A lot can happen between the age 18 to 35. The second option you could consider is if you have more than one child and they are below 21 years old, you have the option to transfer RESP savings into siblings RESP without tax consequences. But each child has a CESG grant limit of $7,200. So make sure you're not pushing over the CESG grant limit when you make the transfer. There is no limit to transfer the contribution and income portion. If the child is not attending, you can withdraw the contribution tax-free and the grant money has to be paid back to the government. But you have the option to transfer the income portion to the subscriber's RRSP without any tax consequences. To make the transfer, you have to have your RESP open for at least 10 years. All beneficiaries must be at least 21 and not seeking higher education. And you should also make sure that the RRSP has enough contribution room to transfer. You won't be able to claim a tax deduction for this transfer. Income that has accumulated in an RESP can be transferred to Registered Disability Savings Plan if the RESP beneficiary is same as the RDSP beneficiary, and the beneficiary must meet the existing age and residency requirements for RDSP contributions. The last option is to withdraw the income portion to the subscriber's name. The income will be taxed at a marginal tax rate, and CRA will charge 20% additional tax. For Quebec residents, the additional tax is 12%. So I hope I was able to provide value through this video. If you like this video, don't forget to like and subscribe. Thanks for watching.